Time now to look at the commodity space. So we have Manisha Gupta joining in. Manisha, what is that one big commodity of the day that you're tracking this morning?
Well, this week actually has been quite volatile, and because of the macro data and what has been being said in sense of various commodities. But one commodity which continues to be buzzing is nickel. If you thought gold and silver were hot, well, nickel has been hotter because we have seen 12% of gains in the nickel prices. And this week, it is 22% up in a month. And when you talk about this year, not just that we're trading at a 5-year highs for the nickel prices, but in 2019 till time, 68% of gains is what you have seen in nickel. It clearly has outperformed the metals and the commodity space by far there. Well, the reasons have been plenty. One, you have seen the nickel inventories on LME and Shanghai continue to decline. The last time you saw all-time highs in case of nickel was $54,000 per ton in 2007. We are trading at around 18,000 to 19,000 at this point in time, and that also is a 68% of gain. So you can understand on what kind of a decline that we've seen in nickel prices in the last couple of years there. Well, as I was saying, the usage of nickel, 60% of nickel in the world produced is still used for stainless steel. The other major use of nickel really is in the electrical vehicles. The chargeable batteries use nickel quite strongly, and as per various reports, one Tesla car, that's an EV car, uses 50 kgs of nickels. And with the kind of momentum and with the kind of growth that we've seen in EV cars abroad and everywhere else, the estimates going forward for the nickel demand are quite on the huge side. So that is one reason that you have seen the nickel prices gain up. The other is Indonesia, which accounts for 27% of global supply. Now, Indonesia has told its miners to ask for new quotas for export for 2019. And Indonesia has issued a report saying that starting 1st Jan 2020, all exports of nickel ore are banned. And that is what has led to a huge spike up in case of the nickel prices. Well, the expectations are that while even as we are standing at 68% of gains for the year, even from here, Goldman Sachs, Morgan Stanley have said that even from here, another 20 to 30% of gains are expected before we end this year. So this is one commodity to keep an eye on. Trading strategies, and we have a couple of them from Globe Capital. They have a sell in gold. We've seen 2% of decline in that. 38,800 is what they're expecting for the day today. It's a buy, though, coming in for the crude oil prices. 4,180 is what they're expecting for that one.
All right. Thanks a lot for that, Manisha. So that's the commodity corner. But getting back to equities for now, the market is holding. I mean, the bank nifty is up, but it hasn't really built onto its gains. So it gives us some time to talk about the macro picture and how it's shaping up. There was that shocker for GDP that came through last week at 5%. And of course, the RBI and the government making a whole host of announcements. Taimur Beg, the managing director and chief economist at the DBS Group Research, joins us now to talk about the state of the economy. Taimur, hi, good morning, and thanks so much for joining us on our channel. You know, the most shocking statistic perhaps from the GDP data this time around was that the nominal GDP growth has come in at a 17-year low of just around 8%. And that explains the very slow growth that we've seen in tax collections, etc. Should we be prepared for much less government spending? I mean, the spending is already well below budgeted targets, but should we be prepared for more?
Well, I think that the spending crunch will come from a variety of sources. One is, of course, the weakness in revenue. Expectations are that some of that weakness can be offset by the transfer that is coming from the RBI. But nonetheless, going forward, it'll be very difficult for the government to breach its fiscal targets because of the communication that has been set out so far that they remain committed to the deficit target. And therefore, the only thing that can be the balancing item, if you will, would be the spending. Now, normally in the past, the first quarter of the fiscal year used to be very slow in terms of execution. Since this government came to power, it's not been the case. Bureaucratic efficiencies have been enhanced, and Q1 has been more characterized by more spending than in the past. But that again will create pressure going to the second and third quarter. In the past, because Q1 was a slow start, you still had a lot of buffer to play with. It won't be as much. So there will be areas on spending which would require close scrutiny.
Taimur, hi, good morning. You know, if we just go back to the GDP numbers, one of the key points of concern this time around was the fact that private consumption slipped quite dramatically as well. I think we were down to about 3.1% for the quarter gone by. Now, do you see that as a transient phase? Or is it something that perhaps could start becoming, a little more structural and more longer duration oriented?
consumption is a very slow-moving variable. You can't turn it up and down just like that. So the fact that it has slowed after many years of showing robust growth is a source of deep concern for me. In all the years that I've covered India, I've never seen volume growth on essentials look so weak. And that is indeed a source of concern. And you can look for many reasons, whether it is weak farm income or uncertainty around manufacturing jobs or the issue related to non-bank financial sector distress. Could be all of the above, but the fact of the matter is we are seeing fairly rare malaise in consumption that we have not seen before, and therefore I don't think there's a magic bullet out there. I mean, having stayed strong for so long, now that it has slipped, other than some seasonality related factor, I can't really see a major turnaround in consumption in the immediate future.
So what should the government do now, Taimur, in your mind? I mean, the common narrative is that monetary stimulus, whatever comes through, may not spur demand, and there is very little room for any fiscal stimulus. So in order to pump prime demand, what should the next steps of the government be?
Well, the recognition that countercyclical policies are needed beyond monetary easing itself, I think, is a positive development. We have seen that bear out in the last couple of months. Before that, it didn't seem to me that there was a widespread consensus in Delhi that the economy needed a great deal of support. So that's a good first step. Second step, I don't think should be coming from the tax side. I mean, so far all the noise we're hearing is that GST rates on product A or product B would be reduced because that's been the complaint from some sellers and manufacturers. I really don't think the rate of tax or the rate of interest rate is going to change the direction of consumption anytime soon. On the agriculture side, maybe there can be some targeted support that can be provided. As far as overall FDI policy is concerned, those things come with long term implications. They are not going to change consumption in the immediate near term. So my take would be that we need to gird for weakness in consumption and come up with measures to offset that, perhaps on the fiscal side, on the spending side, notwithstanding the self-imposed constraint. Maybe there is room for a mid-year budget course correction and announcement of some fiscal slippage targeted entirely toward offsetting the weakness in consumption. But to turn consumption around on a sustainable basis cannot be a short-term game to play. It just won't work.
Well, it's quite dire what you're saying, but I get where it's coming from, Taimur. So if lower taxes can't do it, if interest rates can't do it, if it has to be spending, then how would you like to see the government go about it? I think, in fact, they have been holding meetings with the heads of a lot of the central PSU enterprises to really find out whether some of this huge pile of cash that these companies have, whether that can be used to sort of spur things, spur capex. What should be the right way to spend then, given our limited fiscal resources?
So I think that coming up with stopgap measures like increase wages in the short term or get the surplus cash of these companies to be diverted towards some sort of a counter-cyclical stance, in my view, would be ill-advised. Companies have cash balances because they don't find new avenues for investment, or there are some structural impediments toward running down those cash balances. Otherwise, shareholders should be demanding dividend payment if the company is not being very efficient with its cash management. So I would examine the root causes of why those things are not happening, and I also would not expect cash balances being released for discretionary spending would be a very healthy way to spur consumption in such a large economy. I like the fact that there are efforts being made to improve the transmission mechanism, and therefore if we are going to see deposit rates, lending rates at the retail level come down in response to the rate cuts that the RBI has taken so far, and the pass-through is more immediate, I think that would help. I think that would help bring down cost of funding. On the margin, that would certainly improve sentiments. In my view, in the near term, the government, all it can do is buoy sentiment. I don't think it can hold the consumer's hand and make them buy one more Tata car or one more shampoo from Hindustan Unilever. That would be something that has to happen in a little more sort of bottom-up manner. And the government is a very top-down institution. All it can do is tinker with certain policies and then hope for the best. Given the dearth of growth around the world, even the April-June quarter number of 5% should not be seen as a dire situation. India is doing pretty well on a relative basis. It's only doing poorly relative to India's own aspirations and goals. Perhaps in this world of low growth, some of those aspirations, at least for the near term, have to be curtailed as well.
But the fear now is that, since the government spending has slowed down because of a shortfall in taxes, maybe the worst is not over in terms of GDP growth. I mean, it was 5% this time, but are you foreseeing lower levels? I mean, have you scaled down your estimates for the full year?
Right. So unfortunately, we're living in a world where if you want to entertain downside risks, we can spend the rest of the day talking about the downside risk, both for India's autonomous demand as well as for external demand. Yes, of course, there are concerns about how much fiscal can pull at the economy, whether interest rate cuts would have any material impact on investment sentiment. And unless and until the financial sector malaise is sorted out and the bad asset issues addressed, can the economy on its own turn around? Perhaps the answer to all of those questions is no, but we have to clutch at whatever straw that we can see and just look at the global market news flow this week. What seemed like no hope situation 5-6 days ago doesn't seem that bad. In China, services sector looks okay. In the UK, the cliff edge of Brexit does not seem to be fait accompli. In the US, we got very strong numbers on job side. And the other thing that we have not noticed, or the world is sort of ignoring, is that the US is being characterized by very strong wage growth, which may actually turn around some of the ultra dovish narrative that we have in the markets. So externally, negative cues abound, but positive cues are not that hard to find. Internally in India, like I said, 5% growth is nothing to sneeze at.
It helps when you alter perspective a little bit and just pull back from the short-term gloom and doom. Thank you, Taimur, for helping us do that as well. Take your point on board. Thanks for joining in today. Well, by the way, the market has cooled off as well a little bit from the highest point of the day. So we're just about 30 up. At a point in time, the Nifty was about 50 points higher. So let's see, it's getting a little soft, a little subdued as the morning moves on. We need to take a break on that note. On the